Welcome to the SEO.co Search Engine Optimization Podcast. Digital marketing essentials and next-level tactics. From off-site and on-site optimization to persuasive selling and everything in between. You'll learn actionable tips on what it takes to outright and outrank your competition.
Welcome back to the SEO.co podcast, part 2 of What's the Value of Your Digital Agency? Let's move into cost of capital. The cost of capital in digital agency mergers and acquisitions is more than just the interest rate of the debt used to acquire the business, which can range from 5% to 20% plus, depending on the source and type of capital used. Mezz financing can be double the cost of senior debt. When buyers assess the cost of capital, they also typically take into account comparable next business investments. If I'm doing a comparison as a buyer, I might look at it like this. I have $1 million to invest in something. In this case, I would compare it against 3 separate options. Buy public stocks or bonds, buy real estate with rental income potential, acquire a digital agency. While these are not apples-to-apples comparisons in their risk profile and liquidity, performing this exercise is helpful in determining whether buying a particular business or business asset will be a good investment. In our case, we might ask, if I were to invest my $1 million in a digital agency versus public stocks or real estate, would my increased return on investment greatly overcompensate me for the increase in comparable risk? Acquiring a digital agency has significantly more concentrated, non-diversified risk than simply buying a mutual fund or buying rental properties. As such, the return on investment should greatly overcompensate for the comparable risk. Most sellers don't consider this in their own value calculations when it comes to selling their businesses. Let's use an example to compare. Let's say your digital agency is producing $1 million a year in EBI TDA. The seller wants $5 million for the business. You might say, well, that's a great investment. I'm getting 20% return year over year on my money. That will beat my current stock portfolio. However, the risk profile and capital cost is significantly higher in this private liquid investment than in public stocks or even private real estate, especially if the acquisition is financed with debt, which is very often the case. In addition to the opportunity cost, the cost of capital itself, for example, APR of acquirer senior and subordinated debt, will also play a role in how to determine the value and willingness to pay in an acquisition. We'll get into that a bit more in depth later. A seller might say, but my business has so much potential. If you do X, Y, or Z, it'll double. I know it. When it does, the buyer will be the recipient of all those gains. Buyers rarely pay a seller for such potential unless you're selling a product business, not a service, to Facebook, and that's not going to happen here. If you consider the risk profile, cost of the capital itself, and the opportunity cost of the next best investment, higher valuations rarely compute for a savvy buyer. That's all for this installment. Join us on the next episode and the final part of What's the Value of Your Digital Agency? Thanks again for listening to the SEO.co podcast.
Thank you for joining us on the SEO.co podcast. We appreciate your time. Be sure to rate, review, and subscribe to the show and visit SEO.co for more resources based on today's topic, as well as access to more podcast episodes to help you improve your site's long-term SEO success.